One of the most important things that you can do on your road to financial freedom is to know exactly where your money is going. How much of it are you saving? How much of it are you spending? How much is going to tax? So I created this workbook here. I'm going to call it the Bull Oak Financial Status. We're going to include a link down below so you can download a copy of this and follow along and do this on your own. But I really try to create, I guess, sort of a balance, right? So I want it to be comprehensive and I want it to also be user-friendly. So again, this is the nitty-gritty stuff. There's only so much that you can do to kind of just simplify this process, but I'm going to walk you through all the different sections of this workbook that we created, and hopefully this will help you figure out exactly where your money is going. Okay, so to begin, I'm just going to provide you with an overview of this workbook and kind of how it's laid out and how it works here. So if you notice, we have 4 different tabs down here. We have the dashboard tab, we have income, we have expenses, and we have savings. So when it comes to your budget, you can really categorize them into 3 different sections here, right? So your income, your savings, and your expenses. So that's really kind of how I broke them down here. And all 3 of these tabs and their inputs will feed on over here to this dashboard. And so the dashboard is really sort of the takeaway information that you're going to be getting after you complete this. So I went ahead and took a real client case study. We're gonna name them Josh and Anna for today's purposes. And I took their income and expenses and their savings and pushed it through this workbook here to kind of highlight how this works here. But I went ahead and input all of their information just to kind of save us the time of laboriously going through this, because in reality, as you go through this process, it's probably gonna take you some time if you want real numbers here, real quality data. Okay, so let's begin with the first tab, and I highly suggest that you start on the income tab to begin with because it is the easiest, right? And usually you know exactly what you're bringing in terms of your salary and everything else. So let's begin with Josh. Josh, he brings in about $150,000 per year, and whenever we put together this income worksheet and the expense worksheet, we want all these numbers in monthly data points. So I included just brief directions here on how to do this. The best approach is to just define the monthly average. If you have variable income, figure out what your annual number is and divide it by 12, and that'll get you closest to reality here. So Josh brings in $150,000, and as you can see on this formula here, we just divided it by 12, and that comes out to $12,500 per month. He does not receive any bonuses. But he does receive RSUs. So he is a project manager for a tech company, and a big part of his compensation is RSUs. And whenever you think of RSUs, you want to think of them as sort of like a cash bonus type feature. And it's usually best practice to sell those RSUs as they vest and they become yours, so that you don't accumulate them over time. And so this is exactly what he does here. So he gets the shares, he sells them, and they just become part of his normal budget here. So that comes out to about $4,200 per month. They also have a rental property, Josh and Anna. And so we want to know what is the actual free cash flow from this property, not just the rent itself, but minus all the different expenses. So if you have a mortgage on the property, if you have maintenance expenses, property tax, everything, you want to figure out what is that free cash flow number. So for this, it's $2,300 per month. So total monthly income for Josh is just shy of $19,000 per month. Now Anna's numbers over here, her income is different. So Anna, she works as a salesperson. So her job is to sell sort of B2B at a very enterprise level. And so she is very commission based. So figuring out her income was a little bit more tricky. Her base pay is $175,000 per year. So as you can see in the formula, we just divided by 12. And now her bonuses, it really does depend on what she can do for the year, how well the business is doing, how the overall industry and the economy is doing. So that's a variable number, but we picked a number that she's fairly comfortable with. We did not pick an egregious, very high, lofty number. You want to build some conservatism within these budgeting and these financial plans here, because you don't want to project out better than average numbers. You would rather just project out maybe lower than average numbers. So for her, we projected out $125,000 per year And she said that that's a number that she can probably easily hit moving forward. So that's the number that we're going with for the purposes of creating her financial plan. So her total income comes out to $25,000 per month. So what these totals do, they bring in all these different numbers here for both Josh and Anna. And the total monthly income is about $44,000 gross. Understand that all these numbers are gross numbers, not net of any taxes or any other expenses. So as you can see under the income summary, where this pulls in the number from this income tab over here, and it's just going to provide a nice summary. So there's your $44,000 per month income number, and an annual number is about $527,000 per year. Okay, so now that we have our income, let's move on to the expenses. Now, expenses, again, this is the part that nobody likes. This is the part where you have to kind of break down all of your different expenses here, but I promise you that it's a very good practice to go through, especially if you're serious about planning for your retirement here. Know that there's two different ways that you can do this. One way is the easy way, where you say, look, I know that on average I spend X amount dollars per month. It's variable a little bit throughout the year, but my expenses are pretty steady here. I know I don't have lifestyle creep, and so I'm just going to plug in this conservative number, which is maybe a little bit higher than my monthly average. Most of the time that can work. However, if you don't really know what you're spending, or if you really want to get a good grasp on what your monthly spending numbers are, highly recommend you go through all these different categories and plug them in here. So I already went ahead and pulled in the numbers. I literally sat down with these clients and looked at every single number and asked them just to make sure that these are all correct. And we did have to make an adjustment to a few of them. But real high level, I wanted to at least point out a couple different line items here that it's important to get correct here, because these are common mistakes whenever you're filling out a budget worksheet. So quickly, before we begin, understand that we broke these down into different spending categories. So this is how this budget worksheet works. We have our basic housing, so these are all of your housing numbers. Anything in yellow are the areas that you want to plug in, and anything that is grayed out, it's going to automatically pull that in for you. So try not to mess with the gray cells unless you know what you're doing within Excel or Google Sheets. And then we have utilities, we have housing upkeep, and so on and so forth. We have 12 different categories here, and they all feed into this section right up here. Now, all of these figures here will feed from the expense tab all the way over to the dashboard tab under here. So that's how all of this mechanically works here. Let's talk about a few items just to keep note of. One that you may want to pay attention to pretty closely is your mortgage number. Now, chances are you know what your mortgage number is, because it's probably not a small, insignificant number, but it's important to only plug in the principal and interest number here in this cell, because we break out your homeowner's insurance, your property tax, and everything else outside of that. So we don't want to double count any expenses that are not there. So make sure that it's only principal and interest, just like the real loan amount for this number here, because we back these numbers out, as you'll see later, whenever we're looking at your key financial indicators. Other numbers that you want to keep an eye on are going to be your maintenance number here. So this is your housing number for your maintenance. If you have a brand new house, obviously your maintenance number is not going to be very high, but if you plan on living in this house for 10 years, 20 years, or even longer, then obviously you're going to have some regular maintenance for this line item. So try to project out a reasonable number, because it may not be an expense today, but it will be an expense for you in the future. So again, not the easiest thing, because it's not typically a normal monthly expense on your house, right? You're not doing maintenance on your house every single month. So we just projected out $5,000 on average per month over the next 5 to 10 years. That's where they came up with on this number here. Auto payments is another one. Chances are you're not going to be having an auto payment all the time. You may not have an auto payment right now. Maybe your car is already paid for. Maybe it's like a lease payment and not a loan. But on average, for our clients, between the two of them, they're going to be having some type of a lease, and it comes out to about $900 per month. And last but not least, it's going to be tax payments. Now, tax payments is a little bit tricky, especially if your income is very variable. What we did for them is we pulled up their last year's filing and we looked at what was the actual effective tax rate for both federal income tax and their state level income tax. Now, it's important to keep in mind to use the effective tax rate number and not just the estimated tax payments that you're making throughout the year, because your effective tax number is actually net of all deductions or credits or anything else that you might receive from a tax standpoint. So you want to see what is the real net tax number that I'm paying out to the federal government and the state number here. Okay, so then once you're done, you can take a look at the summary sheet up here, which is the same on the dashboard here, and just see if these numbers make sense. So the total monthly expenses for these clients are about $31,000 with $375,000 per year. That number should feel pretty high to you because you have taxes added into this. So what I like to do is just to take the sum of everything except for the taxes. In their case, that's about $18,000. And I ask the client, does $18,000 per month, does that feel like a right number to you? Does that feel a little bit high? Their answer is, it feels right, but it feels a little bit high, which it should, because you have some numbers that are baked into this number that are a little bit higher than normal, right? Like your maintenance expense, right? You're not paying housing maintenance every single month. You should maybe bake in a little bit of a buffer in these numbers because you are going to have some unexpected costs throughout your life that you can't capture in just a normal budget worksheet here. Okay, and last but not least, now we have our savings worksheet here. So again, we broke this into two different line items here. We have Josh's savings and Anna's. So for both of them, we have them maxing out their 401k. So we just took $23,000, divided it by 12. Even though they're not making monthly contributions, they're actually making bi-weekly, but they are maxing it out to $23,000. So this is the actual monthly average. So $19,016 per month is what they're putting into their 401k. They're also putting $3,000 into their normal taxable brokerage account. So they're just automatically sending $3,000 over and sort of dollar cost averaging into the market every single month. And Anna's situation is a little bit unique here because she is making a mega backdoor Roth contribution. So she is doing her max into her 401k, as I stated earlier. Her employer is also providing a contribution as well, right? They're doing that 401k match, which comes out to about $5,000 per year. And now above and beyond that, she's able to make a mega backdoor Roth contribution. If you're not familiar with what that is, it's a great way to put money into a Roth savings account through your employer. It's a little bit complicated. Not employers offer it. I think about 25% do offer it, but we do write about this quite often. And I will include a link to a post about the mega backdoor Roth to see if that's something that you can take advantage of. So the total IRS contribution limit for 2024 is $69,000. So the total sum of what you could put in as an employee, as an employer into a 401k plan, whether it's pre-tax or after-tax Roth money, is $69,000. So between these two here, she's able to contribute $41,000 into the mega backdoor Roth. Again, the rules are a little bit precise here, so check out this article on this, but this is what she's able to put away for her retirement goals here. So the total per month between the two of them, they are saving $10,666 per month, which sounds like a pretty good number here on the surface. Okay, so now that we've done the hard part of filling out our income, our expenses, and our savings number, now we can take a look and see, does all of this make sense and how are we doing financially? So as a recap, they are making $527,000 per year. They say that they are spending $375,000 per year, and they are saving $128,000. Now, there is an unallocated funds amount of $24,000. What does that mean? That means that $24,000 is not being accounted for. So all I did was take their income minus their expenses and minus their savings, and $24,000 is somewhere. Now, this $24,000 has to either be in their savings. They're either saving more than they realize, or they're either spending more than they realize. And 9 times out of 10, it is the latter, right? People are probably spending more than they realize. So $24,000 is probably going into this expense number. Now, if you find that your unallocated funds number is a lot bigger than you think, then you should probably go through your budget again and see if you're actually missing some line item somewhere. The last thing that you want to do, and this is really where you get to kind of see where is your money actually being allocated, is in this key indicator section that we created right here. So the biggest number that you want to take away from all of this is what is your actual savings rate? So your savings rate is just how much money you're saving divided by your total gross income. And a good target number that you want to target is somewhere between 20 and 25%. If you're saving about this number or even higher, then you are doing very, very well. That means that you're not living above your means and that you are saving towards your future goals, which 9 times out of 10 is going to be your retirement goals, right? So Josh and Anna, are saving 24% of their income, which is just fantastic. They're doing a really good job of setting themselves up for their future. The burn rate is sort of the inverse of this, which is really how much of your income are you actually spending. And so this is all of your spending numbers, not including your taxes, nor is it including your debt. So your mortgage is probably going to be your biggest debt payment here. We're not capturing that in your burn rate because we're actually capturing that in the next section, which is your debt rate. So for your burn rate, a typical burn rate is somewhere between 30 and 50%. It really depends upon your lifestyle. It depends on where you live. It depends on how you live. It also depends on your income. You'll notice that as you begin to start to move higher and higher up the income ladder, your burn rate's obviously going to be going up with that because there's a lot of lifestyle creep that people want to take advantage of, right? And that's okay. You can have some lifestyle creep as long as you're not seeing your savings rate go lower. But for them, they've actually done a really good job of keeping their burn rate pretty low. This spending rate of $375,000 per year, that's a pretty high number, but a lot of that is tied up in taxes and their mortgage. So their spending rate is not actually too out of hand here. They live in California, and California state income tax is pretty egregious. So that's also helping to keep this bottom number here pretty elevated. Now, Josh and Anna's debt rate comes out to about 15%. This is below the 28% number, which is sort of that high threshold. You don't want to spend more than 20% of your income on debt payments, and theirs only comes out to 15%. So they're doing really good financially as well. Now, this vacation rate is a number that we made up on our own because we didn't really see any good data on how much should you actually spend per year on just vacations. And this is a question that we often come across. And so we think that best practice is try to stick to a number that is about 5%. So if you're just starting out and let's say you're making household income of $100,000 per year, try not to spend more than $5,000 per year on vacation. Conversely, if you're making $1 million a year, your vacation budget can be much higher. So you can spend up to say $50,000 per year. So I think a 5% rule is a pretty reasonable number to follow. Next is their tax rate. So not too much that you can do here aside from just some really smart tax planning. Their tax rate's about 30%. They're pretty high income earners, so their tax rate is pretty high, especially in the state of like California. And last but not least, we do have this housing rate, which really says how much of your income are you actually spending on your housing. They're spending about 20%, which is below the 36% high maximum number that we have here. And this is really just to make sure that you're not actually becoming house poor. It's a common trap, especially in this environment where housing prices are really elevated. And so a lot of people will just sort of just reach and stretch and try to get into this dream house of theirs. But you want to make sure that you're not actually doing this at your own detriment and that you're not becoming house poor. Not a concern for Josh and Anna. They are spending below their means. They're doing a good job of saving all their money. So Josh and Anna are doing all the right things. They've been disciplined and they haven't fallen into that common trap of just spend creep and just lifestyle creep and just spending while not actually saving. So I think they have a really good balance of saving for the future, and also having fun today. They have a pretty healthy vacation budget and they do actually enjoy their time. So if you enjoy content like this and you want to see more topics when it comes to retirement or early retirement, or how do high income earners actually prepare for the future, be sure to like and subscribe to this channel. We do release these topics every week. And if you do have any questions or comments, feel free to reach out. We are more than happy to help.